And what do you make of communication services being the leader yesterday? Meta giving it a big boost after that layoff news, and higher than the normal volume into index investing with the SPY and the triple Qs.
Well, no, it was an interesting day, certainly. I mean, we were looking to see if the banks could see inflows on all of the sell-off, but we were in an oversold market, and many hedge funds, many portfolio managers were waiting for the market to move into oversold territory, and they had that yesterday. Certainly, we had a large order, multi-billion-dollar order. At the end of the day, you saw the market pick up very close to the close as that money went into those indexes. The fact is that the market right now understands that the first quarter earnings season is going to be much tougher than what we've had previously as we sort of muddled through. The other part of the story is that we have a scenario in which financial conditions are actually starting to tighten. We enjoyed a period where the lower quality names were moving higher dramatically on the back of or predicated on a very attractive weak financial conditions, loose financial conditions. The picture has changed, and the picture has changed, I think, quite dramatically. And we're going to see communication services, the quality names. You mentioned Meta. Yeah, the market has rewarded companies that are cutting costs, and layoffs have been very attractive for the market in big tech.
Yeah, absolutely. You know, Kevin, Quincy said this word over and over again, quality. I know you're looking for quality names. Late last year, quality meant dividends. Now, with short-term bonds yielding so much, I think the story's changed. Give us a sense really quickly of the metrics that make a quality stock in today's market.
Oh, sure. That's easy. So we want to see at Washington Crossing, we want to see debt at less than about 30% of the capital structure. We want to see profitability based on assets, not equity, much higher than what the market is. And then we're looking for a business that when you look back at performance through thick and thin, those are businesses that have delivered. And all of those things tend to be underappreciated in bull markets like Quincy was describing, where capital is available and liquidity is flush. Those kind of companies might take a backseat as they did last year. But this year, especially with confidence taking a hit, those companies that are able to deliver consistently, and you don't have to worry about credit qualities, those companies suddenly get a bid.
Okay.
And that's very important, especially when the market's under stress.
So, Quincy, I'm going to give you the last word. One thing you're watching is how short covering is influencing the market. I've done some reporting on how short covering has pushed the WCLD cloud and enterprise computing ETF higher. What other areas are you seeing short covering having a significant influence?
Well, you know, I think you're going to see short covering even more with some of the quality names. I mean, whatever is moving higher, that's where you have to cover your shorts. And if the market starts to see, you know, a broad-based quality move in the market, you're going to see short covering. There's nothing wrong with it. By the way, most bull markets, true bull markets, secular bull markets, begin with short covering. It's just that you start building and building and building, and buyers actually come in rather than those just covering the shorts. So there's nothing wrong with that. It is normal. Right now, we're looking to see if we could push through the 200-day moving average. We closed right there yesterday. The market is looking to see if we can build on that and keep going higher and kind of reclaim some of those important technical levels, short covering or not.